Just look at this newly released data from the Federal Reserve Bank of New York. Because the credit card default rates hitting 15% nationally should genuinely send a shockwave through anyone with money in traditional banking right now. Even more alarming is the report from the nation's largest issuer, where the default rate on consumer credit portfolios has shockingly climbed all the way up to a full 22%. We are clearly witnessing systemic stress manifesting itself throughout the entire credit mechanism that quietly supports consumer spending and corporate cash flow across the board. In this video, I am going to immediately expose the crucial consumer leverage trap framework that has historically preceded every single major credit cycle collapse. Furthermore, I'll detail exactly how banks are already responding behind closed doors with very aggressive credit limit reductions and massive interest rate increases. We need to seriously consider the $180 billion in credit card debt, currently sitting in default or severe delinquency across the entire U.S. banking sector. This leads directly into that brutal self-feeding mechanism where unsecured credit losses force banks to cut lending, which then starves consumer spending and accelerates the layoffs and subsequent defaults. You'll see the specific numbers from the big players like Chase, Bank of America, and Citigroup, all showing frightening default figures that, when combined with $17 trillion in total consumer debt, perfectly mirrors the 2008 collapse setup. I am also revealing the quiet, almost hidden mechanisms banks are deploying right now to fiercely protect their own balance sheets against the coming storm. The Federal Reserve is now completely trapped, facing the impossible choice between reigniting inflation by cutting rates or guaranteeing a much deeper credit contraction by keeping them high. Compounding this disaster, the unemployment rate has nudged up while real wages are actively falling because inflation is still running hot above current pay increases. Historically, we can draw clear parallels to the savings and loan crisis of the 1980s, where rapid interest rate spikes completely destroyed the business models of over 1,000 institutions. Remember how back in 2008, consumer credit outstanding plummeted by $175 billion as banks slammed the credit spigot shut, and unemployment dramatically spiked toward 10%. This contraction looks set to be significantly worse than 2008, because total U.S. debt is now 400% of GDP. Stress is concentrated in regional banks, and nobody wants another taxpayer bailout this time.